Well, in the beginning, I need to say one thing. We believe that interest rates need to be set by the free market and not central bankers. We see it as the main problem, but the reality is different and we need to adjust. We believe that the free market knows better where the rate should be. I will give an example with a kindergarten. Imagine there are children in the kindergarten and they buy and sell candy from each other. At some time, the kindergarten teacher, or in our case, the government, comes in and they say, "You children, for buying and selling candy, you need to pay federal income taxes, state income taxes, contribute to social security, pay property taxes, sales taxes, pay for Obamacare, and pay thousands of other taxes." If that would happen in the kindergarten, then believe me, every child in the kindergarten will cry and the kindergarten teacher will not know what to do. So that's what happens today with adults. Adults create a problem, for example, an income tax, and later they try to resolve that problem by debating whether the income tax should be higher, lower, or whether the rich pay enough income tax. You do not resolve a problem by giving an addict more drugs. What is best is to not create the problem in the beginning. It means we cannot have an income tax, and that is the best solution. That's what we mean with interest rates. We say they need to be set by the free market and not central bankers. We say that the free market knows better where the rate should be. Additionally, we say that central bankers do not know where the rate should be, because most of the time the Federal Reserve is not correct when it comes to decision making. Free market knows things better than central bankers and economists. You do not debate whether interest rates should go higher, lower, or stay the same. You just let the free market to set interest rates. We understand that other people, investors and economists may not agree with us, and that's fine. We want the investment performance to tell us who is right and who is wrong. As I said in the beginning, the reality is different and interest rates are set by central bankers. It means that we need to adjust. The Federal Reserve agreed to raise interest rates for the third time in 6 months, and they maintained their outlook for one more hike in 2017. Their decision brings the Fed's target for the federal funds rate to a range of 1% to 1.25%. What we see important in Janet Yellen's remarks is their plan to shrink their $4.5 trillion balance sheet. Their plans to shrink the balance sheet mean that billions of dollars will hit the market. Well, we will definitely not buy any of these bonds. The initial cap will be set at $10 billion a month, $6 billion from treasuries and $4 billion from mortgage-backed securities. Accordingly to their statement, the caps will increase every 3 months by $6 billion for treasuries and $4 billion for mortgage-backed securities until they reach $30 billion and $20 billion respectively. We will see whether it will happen or not. They talk about shrinking their balance sheet by $10 billion per month, and I would not be surprised if they would start another quantitative easing program. Additionally, we need to know that other central bankers around the world very easily can raise their balance sheets by few $100 billion per month. The, the Federal Reserve says that they are data dependent. Federal Reserve and Janet Yellen did not confirm weak economic data in spite of economic surprise index reaching new lows in 2017. Before Fed's June meeting, central bankers said that the weakness in the first quarter was transitory and they expected confirmations of it. Economic surprise index clearly shows that there is no confirmation of any improvements. Retail bloodbath, empty malls, weak auto sales, labor force participation rate being so low, household debt, credit card debt, municipal debt, state of Illinois about to go bankrupt. Delinquencies in student loans, auto loans, mortgage loans, business inventory declines. They are all good examples of weak economic data. Record low volatility, VIX, is another reason which makes me think that things may easily turn around in the financial markets. The budget deficit. The budget deficit rose around 65% year over year. We did not have any tax cuts, infrastructure spending promised by Donald Trump, and the deficit is rising. If the economy is as good as it is described in the mainstream media, then why the deficit is getting bigger and bigger? If the economy would be strong, then the government would generate more revenue. Janet Yellen in the press conference was very optimistic on the economy, and she does not see a recession coming. She talked about improvements in the labor market. Well, we talk about deteriorations in the labor market, and labor force participation rate is the best example. Janet Yellen was very optimistic on the economy. Well, the government, Janet Yellen, and the Federal Reserve can be optimistic on the economy because of the way they measure unemployment and inflation. Janet Yellen said that job gains have been solid and that the unemployment rate dropped to 4.3% in May. We say that the unemployment rate is much higher. Labor force participation rate is a good proof. Well, if you count discouraged workers, unemployed people as employed simply because of this that they are not registered, then you can have that kind of numbers. Additionally, what about the quality of jobs in the United States? We have so many young, smart, intelligent, and educated people in the United States working part-time as bartenders and waitresses. And they are burdened with student loans, car loans, and credit card debt. As I said before, Janet Yellen can be optimistic on the economy because of the way they measure unemployment and inflation. Accordingly to their measurements, we also had weaker than expected CPI, Consumer Price Index. It was weaker at least in the way the government measures Consumer Price Index. In our opinion, real Consumer Price Index is not as described to us by the government. I completely do not believe in these numbers. How do you want me to believe in these numbers? Look at housing costs in America and tell me there is no inflation. Look at healthcare costs in America and tell me that there is no inflation. Housing, healthcare are one of the biggest expenditures of Americans. I do not care if I can buy shoes or jeans for less than 1 year ago. What people care about is that a substantial percentage of their income is spent on rent, property taxes, and other housing expenses. I recommend you one website if you want to have a broader picture of inflation, and it is shadowstats.com. It is run by John Williams, and in my opinion, John is doing a phenomenal job. Even if his numbers are too drastic, then we can easily be somewhere in the middle between his statistics and government's consumer price index. We believe that interest rates need to be set by the free market, and in the beginning of this podcast, I said that the reality is different and that we need to adjust. Well, the adjustment is very easy, and we just always look for opportunities. The adjustment is that we will not buy any of these bonds that will hit the market because of Fed's shrinking of the balance sheet. Additionally, their actions longer term will cause many bubbles to deflate, which I see as something necessary long term. Low interest rates around the world for such a long time caused misallocation of capital. It also means that we will not stay in these certain overvalued asset classes. In the future, because of rising rates, eventually overvalued asset classes will go to their fair valuation levels. The adjustment is that there are always bright spots and we always look for opportunities. You just do not worry and you just be happy. Use your talent, knowledge, creativity, because money can be made everywhere. Everybody has some talent. You just need to enormously value your time and your freedom. I do not want to be perceived as someone with negative thinking. I only talk about the reality because it affects our financial portfolio. If you want positive news, then take a look at Hong Kong, Singapore, or the Cayman Islands. This is XX Report, and talk to you later.